Hello, I'm going to talk to you about paper one, which is coming up on Monday, the 6th of June, 2022, in the morning, clock, Monday, the 6th of June. This is based on the advanced information that we've been told about from the exam board, so topics that will be coming up in sections B and C of the paper. Obviously, section A, we don't know what could be in there. They've got 10 multiple choice questions and some shorter answer questions, and that could be drawn from anywhere on the specification. But I'm just going to concentrate today on the things that we know will be coming up. So section B, just a reminder, it comprises two 20-mark questions. So 14 of those will come from computation each time, and 6 from a written part attached to the computational work that you've done. The topics for this are 3.6 in the specification, which is about preparation of financial statements for sole traders, which isn't just going to be a case of, knocking up an income statement and a statement of financial position. We'll look in a minute at just how wide-ranging that topic is. 3.8, analysis and evaluation of financial information. Primarily, that's going to be on ratio analysis. We've got 3.16, accounting for limited companies. That also crops up in section C. So let's just start with the financial statements for sole traders. So concepts, we could have any of the 10 concepts cropping up there. So prudence, consistency, accruals, materiality, all that kind of thing. So you need to know what they are and how to adjust for them. So things like prudence would impact on inventory valuation, for example. So that could easily be part of a 6-mark question attached to some number crunching. We also need to be able to deal with accruals and prepayments, both income and expenses. You need to be able to deal with depreciation, straight line and reducing balance. You need to be able to deal with the disposal of non-current assets. So that could either be recording a loss or a profit on disposal in the income statement, or using that to draw up a T account for the disposal. Provision of doubtful debts. So you might be asked to create a provision, maintain a provision, and again, that could be recorded either on the face of the accounts or in T accounts. Irrecoverable debts, so how we write those off. Goods for own use, so where we debit drawings, credit purchases, and goods on a sale or return basis, so where we have to remove perhaps an invoice that's been sent to a customer for goods on a sale or return basis, and then add the value of those goods, the cost price, back to inventory, which leads us on to inventory valuation. So remembering that the prudence concept tells us we have to always value inventory at the lower of cost and net realisable value. Okay, so there is more on financial statements. We need to be able to prepare them from ledger accounts, so maybe from a trial balance. It could include T accounts for depreciation, disposals, inventory, income or expense accounts with accruals and prepayments. We've seen all of those in the past. Obviously, the income statement and the statement of financial position, which you should be able to do with your eyes closed by now. We could have to do a trading business, so a normal situation where we've got cost of sales, or we may have to do a service business. So this is one where there will be no gross profit. For example, we just have some fees received from our business. It could be some kind of agency or a financial advisor or some professional fees. No cost of sales, just straight into potentially other income and then the expenses. You can expect correction of errors and or application of accounting concepts at some point. So the likelihood is that the 14 marks will come from the number crunching and then 6 marks attached to that. So you might be asked to make some adjustments and produce an income statement, for example, and then they might pick, a couple of those adjustments and ask you to explain either how those errors are corrected, which errors they are, and then potentially accounting concepts as well. So identify the accounting concept and the correct treatment. So analysis and evaluation of financial information. This is going to be our ratios primarily. So just a reminder here of all the ratios you should know. So gross profit margin, markup, inventory turnover in times per annum and days, profit in relation to revenue, expenses in relation to revenue, return on capital employed, the current ratio, the liquid capital ratio, trade receivables days and trade payable days, and the capital gearing. Gone a step too far there. So capital gearing, obviously an important measure, particularly with companies, to assess the level of risk if we're thinking about investing in them. Continuing on from that, we could be asked to appraise a business, appraise their performance, so calculate some ratios, maybe compare them to a competitor's figures or to previous year's results. And obviously understanding which of those measures relate to profitability, which to liquidity, which to efficiency, and which of them is capital structure. So obviously profitability is important in the long term for any business, but liquidity, certainly in the short term, is probably more important. So having cash available to pay bills as they fall due. Efficiency is about how we manage that liquid capital cycle. So things like receivable and payables days and inventory turnover will come into play there. And then capital structure is just about gearing, really. There's nothing else in there. Understanding the difference between profits and cash. So the idea that they're not one of the same thing. A business can have really high profits but no cash, particularly if it's spent money on non-current assets, or it's paid out a lot in drawings or dividends. And understanding the effect of transactions on profitability and liquidity. We had a question recently, Kareem, which was doing exactly that. We had a series of adjustments, and I have recorded a separate video on this, but we had to assess the impact of each of those adjustments on the profit for the year and on the bank overdraft. We need to understand the limitations of financial statements and ratio analysis. So the fact that the financial statements are prepared at the year end. So anything on the statement of financial position is just a snapshot of what the balance was at that date. So that may not be typical. Companies can often window dress. They'll make a concerted effort to collect money from receivables and pay it to payables at the year end. So just be aware that the figures we're using for ratio analysis may not be typical of the situation throughout the year. The fact that we need something to compare those figures with, we need 2 or 3 years ideally for the same company to help us spot trends. We also need to perhaps have industry averages for comparison. And we also need to take into account non-financial factors, so things that we know about the sector that the business is operating in, whether that's doing well or doing badly at the moment. So a whole load of things to take into consideration. Remembering, of course, that all of the information is historical. So financial statements, just because a business has done well in one year doesn't mean that that's going to continue for the foreseeable future. And yeah, past performance is no guarantee that will be replicated in future. Okay, so limited companies then, section B. This comes up in section C as well. So you need to know about IAS 1, which tells us what the accounts need to include, how they need to be prepared. You need to know the layouts of all these things, the income statement, statement of financial position, statement of changes in equity, statement of cash flows, schedule of non-current assets, and really any of those could come up for a company. If I had to guess, I would suggest perhaps a statement of cash flows. We haven't seen one of those in a paper 1 exam for any of the first 3 years. So I think we need to be prepared, among other things, for that to arise. Revaluation of non-current assets, so where we create a revaluation reserve and perhaps use that to issue some bonus shares. That could be in there. So issuing of shares, rights and bonus issues. Remember, these are the rights issues raise money for the business. The bonus issues just convert existing reserves into shares. We also need to know about the requirement to publish accounts, so how they're used by stakeholders. This is probably more likely to crop up in section C, I would say. So remembering the stakeholders there are going to be shareholders, directors, managers, employees, lenders, customers, suppliers, the community, pressure groups, investors, potential investors, the list goes on and on. So the reasons for publishing accounts, why we do it, benefits and limitations of published accounts. So again, it's the stuff about it being historical and past performance being no guarantee of future results. The main elements and the purpose of each, as required by IAS 1 and the Companies Act, so things like the director's report, the auditor's report, we need to know about those. The purpose and importance of the International Accounting Standards Framework. We don't need to know about the IASs in detail, apart from IAS 1, so what needs to go into the accounts and the responsibilities of directors, that kind of thing. Also, IAS 7 gives us the layout of the statement of cash flows, but really just an understanding that the accounting standards framework is based upon the accounting concepts, and it's a series of guidance. It's not hard and fast rules or laws, of how things need to be done. It's just guidance that need to be interpreted and applied to a variety of situations to help ensure that accounts are consistently prepared and comparable. understandable, relevant, all those kind of things, reliable, show a true and fair view. So on to section C then. This is the bit everyone's dreading, the 225 mark essay questions. I have recorded at least one video on how to tackle these. I'll try and get around to doing some more, but obviously we are running out of time now. 3.2, types of business organisations. So obviously that's things like your partnerships, sole traders, limited companies. So understanding the difference between LTDs and PLCs. Partnership accounts, accounting for limited companies, which we've just seen in section B, and interpretation, analysis and communication of accounting information. Now, it's anyone's guess how these will be presented in the two essay questions, but I would suggest that maybe types of business organisations and partnerships could go together. So you might have an existing partnership where a partner is retiring. We maybe need to make some adjustments, for goodwill, try and work out how much they're going to need to be paid at the end when they leave. Maybe revaluation of assets could come up there. And then linking that with types of business organisations, because under this umbrella comes sources of finance. So we could have a question where one partner's leaving, he or she needs to be paid off. How is the business going to go forward? How are they going to raise the money to do that? Are they going to borrow? Are they going to become a company? That kind of thing. So accounting for limited companies, another question there, combined with perhaps ratio analysis or investor ratios. So let's just have a look at just a reminder of the types of business organisations. So as well as knowing about the different types, you need to know the benefits and risks of each. So the fact that sole traders and partnerships are personally liable for any debts of the business, whereas if you're a company, you've got limited liability because that company is a separate entity. So your personal assets as a shareholder or as a director are not at risk. The reporting requirements, so legal obligations, obviously for sole traders and partnerships, not as onerous as for companies. And then the sources of finance that are available. So making sure that whatever source of finance you recommend, it is appropriate to the business style. So we don't want to be recommending issuing shares, taking out debentures, that kind of thing, to sole traders and partnerships. So just make sure that you know all of the options and how they work. So the fact that interest is payable on loans and overdrafts and debentures, that's not optional, whereas shares, we don't have to pay dividends, so it's permanent capital, doesn't need to be repaid. So knowing the pros and cons of each of those. When it comes to partnership accounts, you need to be able to prepare and comment on the financial statements. So make sure you know what a partnership income statement looks like with the appropriation account at the bottom. So remember, that's how the profits are shared between the partners. Statement of financial position, obviously it's going to have capital and current account balances for each of the partners. Be able to calculate and record interest on capital, interest on drawings, partnership salaries, interest on a partner's loan, and how to allocate a share of a profit or loss. Remember, if there is no partnership agreement, then nobody's entitled to interest on capital, no one is charged interest on drawings, no one receives a salary. Everyone receives an equal share of profits or losses. And the only time that will vary is if a partner has loaned money to the business. We can then pay them 5% interest on that loan, and that will be recorded as an expense in the income statement. It's not going to be part of the appropriation, although it may well be credited to a partner's current account. Revaluation of assets. So I have recorded a separate video of a question I made up, Phoebe, Chandler and Rachel, which goes through the revaluation and dealing with goodwill and transactions when a partner retires. So it might be worth a look at that. Treatment of goodwill in there as well. So remember, with goodwill, credit the old partners, debit the new partners in their capital accounts. That's one of the very few occasions where the capital account balance will change. Back to limited companies then, this is all the same as for section B, really, it's the same guidance. But the topics I think might come up here, more likely, revaluation of non-current assets, issuing of shares, that kind of thing. So remember, we are looking for an essay question in section C. So maybe something on the requirement to publish accounts, why they're needed and who uses them for what. So that could be worth revising. And then the interpretation, communication of accounting information. We've got the financial ratios, which I've just been over in section B, but also the investor ratio. So make sure you know how to work out dividend yield, earnings per share, dividend cover, price earnings ratio, interest cover. Make sure you can find things like the market price per share. So if you've got earnings per share and you know the price earnings ratio, multiply the two together, and that will give you the market price of a share if it's not already provided in the question. Be able to evaluate performance, so internally and across accounting periods, and externally, so in comparison to competitors. So again, thinking about the profitability, liquidity, efficiency, capital structure. Again, the difference between cash and profits, and then the interests of and the effective communication to internal and external stakeholders. So there's a list there, not an exhaustive list by any means. We've got things like investors, potential investors to add in there. And then bolted on the end of this is the impact, advantage and disadvantages of recording data. So this is about computerized accounts. So make sure you understand features and main applications of accounting software. This could come up. It might be that part of a question CSA involves some sort of computerization of a system. Obviously advantages are going to far outweigh disadvantages. Anybody that's done manual double entry bookkeeping using a series of T accounts will vouch for that. So we don't get things like not being able to read our own handwriting. A lot of errors will disappear, but obviously the thing to remember is that the computer is only as good as the information that's fed into it. So it does rule out a number of errors, but it's not completely foolproof. So understanding the advantages and disadvantages of single and double entry systems. So that's kind of veering towards incomplete records, which is not part of our advanced information. So it's one topic that's been ruled out. And then make sure that you can provide a critical assessment of any recommendations. So you understand their impact on stakeholders, considered perhaps on the local economy, the national economy, the environment. In terms of when you make your recommendations, which is usually what you're asked to do in a 25-mark essay question, you have considered, not just the financial factors, but the non-financial factors as well. So a few links for you. I will post these in the notes so that you can click on those, but the full specification, past papers, and the advanced information. Thanks for watching.